Investing passively means asking great questions. If you want to know which questions you need to ask, you want to check out today's conversation with Paul Shannon. Now, Paul is a passive investor, and he's the co-host of PassivePockets, as well as one of the principals with the InvestWise Collective. Now, Paul talks about some of the key questions you need to be asking if you're looking to invest passively, as well as the importance of joining a community of other passive investors. If this is something that you want to do to put your money to work so you don't have to, check out today's episode of Multifamily Insights with our guest, Paul Shannon. When you think you found a great deal, asking the right questions could be the difference in finding a stud or a dud. Listen, we've put together a new guide to help you out. It's called 7 Questions You Must Ask Before Investing in Apartments. Now, in this guide, you're going to learn how to uncover red flags, quickly identify underwriting risk, vet sponsors and team members, and confirm key assumptions. Now, this is a guide that's going to help you be a better investor, whether you're an active investor or you're a passive investor looking to partner with other operators. Asking better questions is the key to identifying great opportunities. So download this free guide. Go to our website, casmoncapital.com/7 questions. That's the number 7 questions. And you can access this free guide today. To make it easy on you, though, we've put a link in our show notes. So you go to the show notes, you can click that link and access the guide right now. This guide's going to help you make better investment choices, asking the right questions to build your portfolio. So be sure to download it today. Paul Shannon is an experienced residential real estate professional, capital allocator, and co-host of the PassivePockets Podcast. Now, Paul has acquired over 200 residential units by recycling equity and/or joint venturing. He has experience in underwriting, acquisitions, raising capital, property management, and project management, on top of being a licensed realtor. Now, he's also an LP, investing in over 40 plus deals as a passive investor, all through multifamily, industrial, sales leasebacks, pref equity, and many more. Let's welcome to the show, Paul Shannon.
John, you're a pro. Thanks for having me today. I'm excited for our conversation.
Hey, Paul, thanks for being a great guest today. We're excited to chat with you. I went over your bio at a very, very high level. Why don't you take 2 minutes and fill in some of those gaps?
Yeah, that sums it up pretty well, concisely. I could ramble on and on about the backdrop here, but I was in sales for 15 years of my career. I was in medical device, capital equipment sales in the operating room, selling the equipment and implants that are used for cataract surgery. I had dabbled in real estate a little bit for, call it 3 years or so. I had done a few single family homes as flips, as BRRRR investments, and was managing a small portfolio. And, kind of saw the scalability and was investing as an LP too in different asset classes, and like the alternative space a little bit more than traditional markets and the volatility that was present in those markets. I couldn't sleep at night knowing that, the Prime Minister of Malaysia could sneeze and, my portfolio could drop 10% and there's nothing I could do about it. So I wanted true diversification. I wanted control over my time. And I wanted kind of my life to be, in my own hands, just could take control of my destiny more or less. And I saw real estate as kind of an easy path into entrepreneurialism. So in 2019, I left corporate work and, took a chance on myself, gave myself kind of a 2-year runway. Certainly want to give credit to the market tailwinds that I received through COVID and the low interest rate environment. Was able to really kind of scale quickly, met some great partners that had some skill sets that I didn't have, that allowed me to kind of offload some of those roles or responsibilities that I was undertaking on my own. And that really opened up my ability to kind of scale my portfolio. And yeah, I have acquired over 200 units. Probably half of those are single family, half are multifamily. Most of them are, heavier lifts, that C-class product that has, high vacancy and has, a tenant base that's sort of hasn't or has been ignored, I should say. And there was a lot of opportunities to improve the property from a curb appeal standpoint, but also drive value through renovations and, increase rents and make the amenities nicer and such. And for a while there, we were refinancing these properties and holding them and, taking our capital. And as you read in my bio, kind of recycling that capital over and over again. We started to bring in private investors and raise capital from others, both debt and equity. And today I run a fund called InvestWise Collective. We're sort of opportunistic and take a different approach. We're anti-niche. I found that, over the course of the last 5 or 6 years being full-time in the space, I've had to pivot in strategies at least 3 times. And if you consistently try to scale in one, specific strategy in one specific market, for me anyways, it ended up being kind of like jamming a square peg through a round hole. So had some success investing as an LP, had some success investing as a GP, and thought, why not combine these? InvestWise Collective is really asset agnostic, opportunistic. We've taken some LP positions where we thought it made sense in the form of debt funds and moved down the capital stack and paid our investors income. Right now, we're raising capital for an A-class multifamily property that we're going to GP. So there's, kind of an open season as far as what our appetite is. If we're going to be general partners and manage property, it's going to be, more specialized to our expertise, and we're not going to get too broad. But if we can take LP positions and partner with good sponsors and great operators that have expertise in areas that we don't and offer diversification and benefits and access to our investors that they otherwise couldn't have, we're going to do that too. So that's kind of where I am today. I'm also co-host of the PassivePockets Podcast. So I'm really an LP first. I love being an LP. I love leveraging other people's expertise. And, long term, I think that's where I'll end up with most of my portfolio as a passive investor.
Paul, I love it, man. You gave us a lot of great information on your background, right? We're going to jump more into the InvestWise Collective and the PassivePockets podcast. But you talked about working in the medical sales field, right? Doing that for 15 years. You started investing in real estate on the side for a few years and then realized, hey, maybe there's an opportunity to do a little bit more here. You mentioned, in 2019, that was the year where you said, you know what, I'm going to bet on myself. I'm going to go full time into this. Can you give us a little bit more context of what that looked like? I mean, were you flipping houses? Were you buying single family houses? I know you mentioned that you were doing kind of C-class residential units, but when you made that decision to go full time in real estate, what did that portfolio look like and what was your investing strategy?
Sure. Yeah, leading up to that, I sort of had that analysis paralysis. I mean, I'd watched like HGTV when 2010, 2011, and was really enamored with the lifestyle and the glamorization of it all. And then I read a ton of books, and I just didn't take action, and kind of had the bird in the hand. I mean, when I got out of college, I kind of saw sales as my track, and medical device was really the long-term goal. For 5 or 6 years, I was doing other jobs within the sales realm. The last 10 years of my career, I was in that space, that medical device space. And I just thought, hey, this is kind of the panacea. This is the goal I was after. I'm here and I'm making really good money. How could I let that go at this point? But I was hollow inside. I was just empty. I wanted to do something different, and I wanted to take a chance on myself. So I started, getting into real estate. I finally took the plunge. My first property was a duplex that was built in like the turn of the century. It was like a 1900s duplex, had all the old house problems. Had tenants in it, just managing those tenants and trying to build relationships with the contractors and figuring out, how to run a house, basically, what makes it work, right? All the plumbing systems, the electricity, like, hey, the roof's leaking. Where's that coming from? How do I fix it? Who do I call? So all this stuff leads towards kind of like a rite of passage, right? You start to learn, you start to build that experience, you get more confident, and then you take on an additional project. So that next project for me was a single family house that was built in the 50s. It was a flip, had a horrendous crawl space that would make anybody, just get scared of what's under there. You had some mold issues, pretty much a gut job, and that was that next rite of passage. So I started to build that confidence level. And by the time 2019 rolled around, I had, I think I had seven single family homes in that duplex in my portfolio. So it wasn't a large portfolio. I was managing myself. I kind of had this vision when I left my W-2 job that I would be a property manager. That's how I'd make my day-to-day income. I was, doing that already, and I was starting to build connections with contractors and vendors. And, I had my real estate license, so I was going to maybe do my own transactions, buying and selling, and make some income that way, maybe with others that may buy my own properties that I flip. Well, it didn't work out that way. I figured out pretty quickly that I was a terrible property manager. It's the dirtiest job in the business. I wasn't good at it. At least in that space with C-class single family homes. So I needed to get less out of the weeds and be more big picture, which is what I enjoyed. I enjoyed the acquisition side, talking with lenders, networking, putting deals together. And I started to be able to do that when actually my strategy, what I was alluding to before in the show, stopped working. It started to be like jamming a square peg through a round hole. I was using that burr strategy to grow my rental portfolio, and I was no longer able to get the equity out of the houses that I was renovating. And that capital that I had was going to run out. So I needed to find private money, and I needed to find a market where I could actually do that. So I started looking around tertiary markets because the returns were a little bit better at that point. And I stumbled across Evansville, Indiana back in 2019 and met a property manager who I really hit it off with. They were hungry. They had a portfolio of 800 or 900 units at the time. They had a construction crew, and I was 3 hours away. So I couldn't be that micromanager. I couldn't be in the weeds. I had to delegate, and I had to offload a lot of the responsibility that I was dealing with back at home in Indianapolis. So that was a big turning point for me. And in the late 2019 into 2020, we bought 20 or 30 units that year. And we really kind of scaled up during that 6-month time frame. We bought a few packages and took on some heavier lifts, and the market tailwinds were strong at that time and things were going really well. So that was really the turning point, though, is when I plugged and played in. Yeah, I started to pay a property manager. I started to pay some other contractors. I started to pay for convenience, more or less, but I started to open up my time to be able to find more deals and grow my knowledge and grow my network. And that made a big difference.
Paul, when you found that group, had you already left your W-2 to be okay? So following this, you quit your job. You're going to manage your properties. You got the 7 houses, the 1 duplex. You're self-managing these. You realize, man, I'm actually not that good as a property manager. I'm not as good as I thought I was. And you also had this strategy where you were buying properties deeply distressed or, heavy upside. So you're putting a lot into them. You're going to refinance to pull out your equity. But that strategy stopped working where you couldn't pull out your equity. So you had to pivot. And I think it's important because it's scary for a lot of people to leave your W-2 job, especially if you're making great money, making 6 figures. And especially if you're the sole provider or the main provider for your family, to walk away from that to chase this real estate dream and then to have your strategy not work. I can only imagine the stress that you might have been going through and the challenges that you face. But the great thing is you found a pivot, right? You recognize what that challenge was. And that's the real insight I want folks to take away is, you've got to take the next logical step, but then also recognize if that's not working, how do you adjust? How do you pivot? In your case, you realized, hey, I can't be micromanaging this. I've got to be able to play this game at a higher level, which means finding people who have the skill set and have the abilities. And that's what that team out in Evansville afforded you, was the ability to scale and grow and tap into some of the things that they had already figured out. So can you share a little bit more for anyone who's in that situation today? They're just mentally drained. You said hollow inside with your W-2, right? So they've got the emotional disconnection from their job. They want to go full-time into real estate, but the finances may not necessarily justify it today. What advice would you give that listener?
I would just take action, right? I mean, that's probably cliche. I'm sure your listeners have heard that before from other guests on the show. Transparently, one unfair advantage I may have had was that I was diligent in saving a lot of capital. My personal, net worth was at a point where we had the opportunity to take that risk, where it was a little bit safer. We had some money in the bank, so to speak. It took 15 years to get there. And I don't think I would have been as comfortable, let's say, 5 years out of college doing the same thing, right? So there was sort of a mindset shift. I also had that additional 10 years to kind of go through the pain and suffering to realize that the track I was on wasn't necessarily where I want to be. There's a guy I talk to pretty regularly who, I think he looks at me as somewhat of a mentor, and I certainly, want to see him do well, and I'm invested in his success. And we've been talking for like 3 years now. And when we first started talking, he would talk about how his job was tough and he didn't like it. And he was, on the wrong path, and he saw real estate as an outlet. As we kind of nurtured our relationship, I saw that pain growing. And now, like 3 years later, him and I just talked earlier this week, and he said, man, you were right when you said that the pain has to be there for change. He said, I thought things were tough 3 years ago when we first started talking, and I didn't like where I was at. And now I really feel that. And now I'm ready for a change. And he started to finally take action. He's going to get a certification that will give him the skills that he needs to underwrite multifamily properties. So he wasn't taking that kind of action before because the pain wasn't there. So for me, 15 years into my career, I knew I couldn't, do what I was doing day to day for another 20 years for my career. It just got to that point where I was like, you know what, it's better that I just take a chance on myself. There's a number of factors here at play. I can always fall back on my career. I have the skill sets. I have the experience. That is plan B. But plan A right now is to plow forward and take that step. And you have to realize too, I think it's true if you're an entrepreneur in any field, if you're in a startup world, or if you're in real estate, if you, if you run a coffee shop that you're getting off the ground and you rent a space in the strip mall and you're just getting going, there's going to be friction. There's going to be challenges. You're not trading a life of suffering and pain in the W-2 for this rosy, world that you're sort of feeling like you're on vacation all the time. That's not real. Like, that's just not real. The truth is that there's always friction. There's always challenges. And I know for me personally, like, as I've come through this journey 6-7 years out now of the W-2 world, I am so much more prepared to take on challenges. I don't get my feathers ruffled over minor things. Some things are kind of major. And you look back and you're like, man, I would have freaked out about this 10 years ago. But this is sort of like day-to-day business. And you just kind of calm down and you make your nerves go down a little bit, and you realize that you can get through pretty much anything. You just have to keep moving forward and put one foot in front of the other. So that's the advice I would give, is just take action. You don't have to quit your job right away either. Yeah, you kind of make a little runway for yourself and see, okay, I'm having a little bit of success here. Really, the problem is time. And that's what it was for me. And then you can invest in yourself and you can leave that W-2. So, it doesn't have to be all or nothing, and it can happen over a period of time.
Paul, I love that. You talk about the pain has to be there for change to occur. And if you're not feeling the pain, I mean, the reality is you can listen to our conversation. You're probably not going to do anything, right? You're going to go back to work and do your job and, sit there and dream and think about it. But, when that pain gets real, and when you're finding yourself missing, family events, or getting passed over for promotions, or just quite frankly feeling miserable and hollow inside, that's when you recognize, all right, it's not about just the salary. It's got to be about something else. It's got to be about purpose and fulfillment and joy and family. And that's when you can really take your attention to say, all right, how do I actually change this? How do I change my situation? How can real estate help me to do that? I know you've been able to do that. I've been able to do that. It's something that, many of our listeners are trying to do as well. Paul, let's talk about kind of where you're at today, right? You've got the InvestWise Collective. You talked about being able to invest in different asset classes, different strategies. Where the market's changed a lot in the last few years. So talk to me about kind of how you see the market today and what kind of opportunities are exciting for you.
Sure. So to talk about the market today, you really have to go back a few years. Obviously, with the COVID period, we went into the zero interest rate period, where the federal funds rate was at zero, and interest rates, on homes were very low, sub 3% in some places at certain periods of time. You could acquire multifamily properties with 3% interest rates. Cap rates were really, really compressed in some markets, sub 3, even 3 caps, 4 caps in Florida, Texas, those areas. So things got kind of frothy, and that's when we started to scale into larger assets. We'd acquired a 40 unit. We got into the same size property in Indianapolis, in Evansville. So we had 80 units within a short period of time, and we were ready to go bigger. And, we started underwriting deals, and we just couldn't make sense of what was happening in the market, particularly in early 2022, when Jerome Powell started to telegraph that rates were going to be going up. And all the talk about inflation being transitory, it was sitting at 9% roughly at that point. It was starting to not hold water anymore, and it looked like it was more of a structural issue. So if you look back at history, rates had been in the 80s, much, much higher, into the teens. And you look at Jerome Powell's idol, who's Paul Volcker. He was the Federal Reserve chairman back in the 80s who broke the back of inflation, right? And he really did so by raising rates pretty quickly. So I was just kind of connecting dots in my head, and I've certainly been wrong so many times about so many things. But in this particular case, I thought, I don't like the idea of acquiring multifamily with floating rate debt. And a lot of the transactions, I would say almost all of them, were getting done that way in 2022. So as we're underwriting deals, we're underwriting to fixed rate debt, raising the money from investors for the CapEx. And in doing that, when you bring more equity and you use less leverage, you can't pay as much, So we were coming in at 85% of guidance on a lot of these transactions that we were going after. And we got tired of banging our heads against the wall for, a long period of time, underwriting probably 150 deals and making offers on a third of those. We thought this isn't going to work. And we don't know, again, jamming a square peg through a round hole, we don't know when this is going to end. So a couple partners and I had been investing passively and been finding opportunities outside the multifamily space where we felt like we had, an expertise and unfair advantage. But if we could leverage the expertise and unfair advantage of others and get into deals that maybe we otherwise couldn't get into ourselves personally, either because of high minimum investments or because, we could potentially get better terms by bringing a larger check. What if we could pool together our money individually? And then we thought, well, what if we could pool together money from our investors too, and make this more of a fund type operation? So that's what we did. That was born at the very beginning of 2023, InvestWise Collective. And at that time, multifamily was really struggling. The peak had sort of occurred and there was the downswing a little bit. And we thought from a risk mitigation standpoint that moving lower in the capital stack made sense. So we really liked the idea of investing in private debt, being the lenders basically, and being in the senior position, ideally, where you have first rights to the collateral, the underlying real estate. If you could do that, have that collateral at low leverage, you could get some income in current pay distributions, which sounded really attractive because a lot of multifamily investors who were in our network were having issues with their portfolios, having distributions paused or whatnot. So we had a good thesis and we had a good solution to those that were thirsty for income. And that really helped us grow our investor network, investing in those debt funds. And there's some other asset classes that we really like as well. We're starting to really think that multifamily is at a good time to buy at this point in the market cycle. And we actually have a deal right now we're raising for where we're going to be co-GPs on that is a multifamily deal. So the market's always shifting and, our thesis isn't always going to be correct, but what our approach has always been is that we're going to take, an approach that we have preservation of principal in mind first. We protect the downside. We don't get emotional about deals. We don't get swept away by a pro forma with high returns. We really like to focus on the inputs and what makes sense from a realistic standpoint as far as what goes into the underwriting, as far as assumptions are concerned, not necessarily the outputs being like IRR, equity multiple, cash on cash, all the stuff that gets people really excited. It's like, hey, what's the underwriting model look like? If we can mitigate that downside and still provide reasonable returns as well as diversification away from traditional markets, we feel like we have a competitive advantage by keeping our asset class and position in the capital stack agnostic. So we're gonna take LP positions, we're gonna take GP positions, and we're gonna be a little bit different, I think, than some people are used to.
Paul, you said a lot of really great information, right? Really great things. But I want to pause and just give people a chance to process it, right? If you're not deep in the weeds in this space, some of what you said may have gone over their heads. So I want to play some of it back, right? First of all, you talked about the market and what was going on, and you recognize that, hey, there's a really good chance that interest rates are going to shoot up. And as you were analyzing deals, you were coming in at 80 to 85% of the target price that the brokers were telling you. And you weren't winning any deals for that reason, right? Other people were more aggressive with their underwriting. You guys were anticipating that you wanted to have fixed debt just to navigate the next cycle. So you weren't winning deals. So you kind of got together, you launched kind of the collective fund. And now as you look at opportunities in multifamily, your thesis is first and foremost the preservation of principal, meaning whatever you invest, you want to make sure the deal can get you that back. Now, obviously, there's no guarantees when it comes to investing, but given all of the data points that you have, that's one of the key factors is, hey, what are the risks in this deal as far as me getting my money back? If I can get my money back, all right, now we can move on to step two, as long as we feel like there's a good foundation here. You also said something that I think is so insightful, and I want to make sure everyone understands this. When you are looking at the underwriting, you're paying attention to the inputs, not necessarily the outputs. And so many investors, they fixate on IRR or cash on cash returns or whatever the investor return metrics are. And I recall I talked to an investor on one of my deals a few years ago, and they did not invest in my deal because another deal projected a higher IRR. And I was like, you got to be kidding me. Like, who knows what inputs that person used to get, like, I can change any number in my underwriting and get you a 20 IRR. It doesn't mean it's realistic. It doesn't mean it's going to happen. And you certainly shouldn't be investing just because the projected returns are higher on a deal, right? Like you really want to understand the assumptions. And that's what you're talking about here. What are the inputs? What are the assumptions? What is the growth rate? What are the taxes? What are the insurance? Like, what is the occupancy? You need to understand the business plan. What's the plan? If you're investing passively in a deal, you got to look at where the property and the business is today. And then what is the business plan to get this thing to a stabilized, operation number, 2 years, 3 years, 5, whatever the time frame is. What's that plan? And then how much risk is there in the execution? That's really what we're shooting for. Yes, we like deals with higher investor return metrics, but again, you really need to be analyzing deals based on the inputs, and it's harder for newer investors to understand that, which is why I think it's so important to talk to folks like Paul, talk to folks like myself, who can really help you understand what to pay attention to in these deals. You've got the podcast now as well, right? This is a good segue. You talk to folks about passively investing. Talk to me about some of the challenges or, the questions that people have, especially as they're learning how to be a better passive investor.
Man, that's a great question. And I've actually written an article with 50 questions that you should ask a general partner. And you can't get through 50 questions on a 30-minute phone call that's introductory, but you can kind of pick and choose what's most important to you. But as you're evolving in being a limited partner, I mean, you get a more keen eye as you look at more and more deals, right? And I wouldn't suggest necessarily trying to learn every asset class all at once. I don't know every asset class. I'm invested in asset classes that I have a baseline understanding in, but I'm not an expert where I can go out and operate that property as a general partner. And that's why I kind of like passively investing, is because I can leverage the skill sets of other operators and get diversification in asset classes or geographies even. I think I can run multifamily pretty well, but I can't do it in Arizona, for example, but I like that market. So, there's value to riding on the coattails of someone who has an unfair advantage and knows all the people in the market and gets access to deal flow that otherwise, you could never get if you're sitting in my shoes in Indianapolis. So I would say, focus in on one asset class and get comfortable with that asset class first. And multifamily is a really logical place to start because it's, one of the more popular asset classes. It's one of the more stable asset classes throughout the course of history as it relates to real estate. Everybody needs a place to live. That's a cliche thing, but it's true. Supply and demand has been a bit out of balance lately, but that will resolve itself here shortly, I believe. And, multifamily is going to continue to do well, through good times and bad. But really, getting back to your question, I think, it starts with the sponsor. It starts with who's operating the deal. You can have a really great deal, but a poor operator, and they can mess up that good deal. And then you could have a pretty average deal, and you could have a great operator, and they can make that into a double or a triple. So I think, focusing on the jockey and not the horse necessarily is really important. Who's steering the ship, so to speak. That's your first step. And, it starts with track record. Have they done this before? Are they capable in executing the business plan that they're proposing? Are their assumptions realistic? Going back to that inputs, we talked about on the spreadsheet. I've had a similar conversation, by the way, with an investor who said our returns are not meeting their standards. I said, hold on, we're on a Zoom. Let me share my screen. I pulled up our underwriting file and I changed the exit cap by like 50 basis points.
I should have did that.
I changed the whole period by like a year. And I said, there you go. There's your 17. It's not a 15 anymore. So, spreadsheets can be manipulated. So understanding kind of like the underlying psychology of the operator too, and their risk tolerance, and making sure that you're in alignment with their risk tolerance. And there's some passive investors that say, hey, I've done my due diligence on the sponsor. I've had a couple deals with them and they've gone well. I don't need to look at their deals anymore. I just know I'm going to sign up and subscribe once they come out. And I think that's kind of dangerous personally. Like, I think it's not because I think that person has changed from a moral standpoint or they're not capable of handling. It's just, you want to always make sure that your risk tolerances are aligned. And sometimes people's change, right? So I think it's always good practice just to look at the deal, but it comes secondary to the sponsor really. And I think diversification, as I've alluded to before, is key. So the goal longer term should be to build out a portfolio of passive investing positions amongst asset classes, amongst sponsors. Doesn't have to be, 50 sponsors. It could be 5 or 10. Different geographies, different debt maturities, right? If you loaded up on multifamily in 2021 and everything was done with bridge debt and everything's maturing in 24, 25, whatever it is, you got a problem in your portfolio. So if you got some 3-year, maybe a little riskier debt as part of your, upside, going for the home run type stuff in your portfolio, that's fine. But also kind of mix in some 5-year, 7-year, 10-year debt and make sure it matures over, a laddered period. So you're not facing, what could be a tough time in the economy, and you can't, the sponsors can't refinance that debt. So, I said a lot there again. I just keep rambling, John, but this is kind of my approach. And I think, you just get more rounded the more deals you look at, the more sponsors you talk to, and a community matters too, like Passive Pockets. I think that's, a great way to kind of learn from others who've already been there, to ask questions, to other passive investors. Maybe if you're considering a sponsor, you've got a community to turn to and say, hey, has anybody had experience with John Casmon? And like, oh yeah, we've gotten great returns from him. And that's just confidence building, right? And you've got somebody that says, hey, I vouch for this person. They've performed. So if you don't have that network, I know for me, when I started investing passively in about 2016 or 17, I tried to do it alone, and I got into a couple of deals that didn't go as well as maybe they would have if I had talked to somebody who had already invested with that sponsor.
Let's talk a little bit more about community, because I think that's really important. And just, you hit on a couple of really good points. So I think the big takeaway I have on what you just talked about was really making sure that you are vetting the sponsor. And when we say vetting, you have your list of 50 questions. It does not mean sitting down and drilling somebody with 50 questions at once, right? It really comes down to making sure this person has the ability, the expertise, the experience to execute the business plan and the project that they are putting in front of you, right? And that you understand the assumptions. And more importantly, they understand and they have thought through the assumptions and how they're going to handle different challenges that may arise in the deal, right? So it's really about that process of making sure that you are comfortable with the person you're placing a bet on, because you're never going to know every single question to ask. You can't identify every scenario that may impact the business plan or rent growth or anything like that. So the best thing you can do is focus on the who you're investing in and make sure that they have the ability to execute that deal. When you talk about the community, though, I love that, because I think it's so helpful. And, when I was starting out, I was pretty active on Bigger Pockets, and it certainly helped me get traction. I was attending meetups. I ended up launching my own meetup. I ended up launching a conference. But really, I did those things so I could be surrounded around other people who had knowledge, who had expertise. I could figure out what they're doing. Obviously, we could raise capital for our deals, but that gave me the confidence to go out and move, not aggressively, but move with confidence on the decisions I was making, because I had a network of people I could go talk to, with my mentors, coaches, other folks like that. So when you talk about the passive investor, you go back a few years, there really was no community for these individuals. You kind of went out there, you came across a guy and you hope the deal worked. And now we're starting to see that grow, particularly with Passive Pockets. Can you talk to me about what Passive Pockets is and how did you get involved with the podcast?
Yeah, sure. There's other groups out there, right? To your point, there's starting to be these little pockets of communities that are popping up, and some are put together to kind of negotiate better terms with sponsors if they can write a bigger check, and really don't have like a profit focus. It's more of just let's get better terms for our investments. Others are more focused on collectively kind of putting together like an encyclopedia of who all the sponsors are and what's their track record and performance, and sort of a book of data that you can tap into. Passive Pockets, I think, is a little bit different. It started as the Left Field Investors back in 2020. It was Jim Pfeiffer at the time and a group of other guys that came together in Columbus, Ohio, and they intended to meet live and in person. But then, of course, the pandemic happened and that wasn't possible. So as everybody was sort of hiding in their basements for 6 months, they put this online and they started to grow the community. They put out forums where people could connect with each other and chat. They put out a lot of educational content in the form of a podcast. They started a meetup that turned into a conference. So it really grew into something that I think that they didn't expect. But Jim Pfeiffer was a friend of mine, and we had, stayed in touch for quite a while. I helped write some blog posts. I came on the podcast a couple of times. He kind of liked my analytical approach to the market, and then I had some active investing experience along with passive investing experience. So I think connecting those dots for me anyways has been really helpful to be a better passive investor. So I was kind of sharing my experience with the community. And then come 2023, InvestWise Collective was launched out of Left Field Investors in partnership with that group. They got bought by BiggerPockets, and InvestWise Collective was spun off. We were the redheaded stepchild. Nobody wanted us, so we became autonomous, and it ended up being great. I mean, it was a good move on their part, and we didn't have any issues with that. But kind of stayed in touch along the way as that transaction occurred, and got involved with BiggerPockets, and continued to have conversations with their group and their leadership team, and they have ambitions to scale PassivePockets bigger, of course. Now that they acquired the Left Field Investors and rebranded them. So I was brought on board to host the podcast as one thing, but I do some other thing behind the scenes. And there's a couple of, if you're a subscribing member of that group, there's some things that are behind the paywall, so to speak, that are really, I think, insightful. One of the things that we do is we do what's called the deal review series, where a sponsor will come on and they'll pitch their deal essentially for 15 minutes, a really compressed version of it, assuming that investors have already seen the webinar, and then an experienced panel of LPs, some of which are fairly well known on the circuit, so to speak, come on and discuss the deal, ask questions of the sponsor, more in the weeds type stuff, getting into the PPM, getting into the operating agreement, identifying macro risks. And it really is intended to kind of give passive investors a look behind the curtain as to how experienced LPs approach operators when they're considering deals. And then the operator goes, and for the last 15 minutes, the LPs discuss the deal and what they see as the key risks, and whether or not ultimately they would be interested in potentially investing. So that's one of the things. But there's a lot of stuff in the works. There's a lot of educational content. It's a great community for experienced LPs who want to connect, who want to collaborate. Going back to what I was saying before about having that kind of resource to fall back on and talk to other investors who've maybe invested with a sponsor they're considering, but also for newer investors who are just considering passive investing in real estate and see the value of it, but don't necessarily know how to navigate it or how to find sponsors or how to take that first step to become a more savvy investor. So it's really for the 100 level through the 500 level. And I've really enjoyed being part of it thus far.
Oh, I love it. Listen, if you want to check that out, you can go to PassivePockets.com. And on top of that, if you want to learn more about the InvestWise Collective, you can go to InvestWiseCollective.com. All great information, and love everything you just shared there, helping out our passive investors. Let's transition and go to our round of insights. They say you're the average of the 5 people you spend the most time with. So if you want to grow as a multifamily investor, you have to spend more time with other multifamily investors. And an easy way to do that is to join our apartment investing mastermind group today. Just go to CasmonCapital.com and click on the mastermind button. Now, as a part of this group, you'll get access to expert trainings, group coaching calls, industry news and updates, as well as all of our webinars and workshops, including our 3-hour workshop on raising capital. Again, if you want to be around other multifamily investors that can help you scale your portfolio today and grow your network, make sure you're a part of the Apartment Investing Mastermind. Just go to CasmonCapital.com and click on the Mastermind button today. Paul, give me a failure or an apparent failure that sets you up for later success.
Well, I'd go back to what we talked about at the beginning of the show and failing as a property manager. That was the best thing that ever happened to me. And we didn't really get into it, but when I left that W-2 job, it was probably 6-8 months into it. And I had that, oh crap moment. What did I do? I don't know where I'm going here. I have to pivot, but I don't really have a big plan in mind. So it ended up being kind of realizing that it wasn't, it was who could help me, not how could I get it done, right? That book by Dan Sullivan ultimately is what it came down to. And I found the right people that could complement my skill sets and take me to that next level through that challenge. So kept going.
Give me a digital or mobile resource you recommend for our listeners.
Digital or mobile resource? Oh man, I mean, you're talking to the wrong guy, John, honestly. Like, I am not the tech guy at all. I can't even figure out how to get this video started when we were going on here live. So no, that's funny. I'd say just like Slack has been a big deal for me to stay in touch with people that are in our community, and to keep workflow moving. It's just an easy way to stay in touch, and it's not as burdensome as email and text. So
Slack it is. Give me the book you've recommended or gifted the most in the last year.
Creature from Jekyll Island, easily. I think I've given that recommendation more times than I can remember, but it's been floating around my neighborhood too. It's a history of the Federal Reserve, and I found that understanding financial history and where we've been in the past, history doesn't necessarily repeat itself, but it often rhymes. So seeing how things have unfolded in past times, you can relate it to today and make a lot more sense of it than the headlines.
Give me a daily habit that helps you stay focused on your goals.
I invest in my health at the beginning of the day, every day, and start with a workout. I think it just clears my head. It wakes me up, gets me focused. If I try to do that towards the end of the day, I get too distracted and I get grumpy if I don't get it in. So I got to get it in right away.
I love that. All right, give me your number one insight for investing passively.
Don't think that the space is small. There's not a generational opportunity that's out there necessarily. It's a lot of times you find that when you're new in the space, you feel like you get presented a deal and it's the opportunity of a lifetime, that you have to jump right on it. You can't miss out, and you get this sense of urgency and FOMO if you don't make that investment. I'd say keep looking at deals, get on distribution lists, and don't think that you're missing out. There'll be another deal in your inbox. That's a good one. It's okay to say no.
I love it. And make sure you're comfortable is, the thing. If you're not ready today, ask more questions, but get comfortable so you can move forward when you do come across that deal. I love it, man. And Paul, you're in Indianapolis, as we've alluded to earlier. Give me your favorite place to grab a bite to eat.
Ooh, that's a tough one. It's not downtown Indianapolis, but there's a town called Fortville that's on the outskirts. And there was a chef downtown Indy that wanted to bring his culinary skills back to his hometown. And he did that, and he transformed this town from like a 1950s sort of Rust Belt failing town into now it's vibrant. And it really has to do with that restaurant. It's called Fox Garden. If you ever can make it to the Fox Garden, you'll never have a better steak. They got a great whiskey bar upstairs. It's small, it's quaint, and the town itself is a water tower town. It's really cool, really cool.
I love it. Fox Garden it is. Yeah. Well, Paul, you gave us a lot of great information in our conversation today. I loved hearing about your journey from the medical sales world to being a full-time real estate investor, failing as a property manager and having to pivot, and recognizing that you need to find the who, not the how you could scale. And for you, it was that group out in Evansville that allowed you to scale that portfolio. And then from there, recognizing that there's a community of other folks who are looking to do the same thing, working with Jim and, at the time, Left Field Investors, now PassivePockets, being a co-host for that show, as well as launching, the InvestWise Collective and helping other investors find great opportunities today. Again, if folks want to learn more, you can go to PassivePockets.com or InvestWiseCollective.com and learn and connect with Paul there. Paul, thanks again for being a great guest and coming on Multifamily Insights. We look forward to staying in touch with you, and I hope you have a great day.